Hi, welcome everyone to another episode of Let's Talk Special Economic Zones. I'm your host, Ainsley Brown, and in today's episode, we are going to talk about the global corporate minimum income tax. Are you in scope? Now, what exactly is the corporate minimum income tax, and how does that impact zones? Now, let's talk about why it's impacting zones first. So, zones are what's considered preferential regimes. Typically, zones have some level, and this is specific to corporate income tax. And I should say, before I go any further, zones, no matter what you call them, free zones, free trade zones, enterprise zones, special economic zones, whatever you want to call them, it's the same thing for this purpose. Now, in terms of um, what zones are from a tax perspective, or some zones at least, um, they're preferential regimes. Well, all of them technically are preferential regime, but for income tax purposes, some aren't because there are some that don't offer that as a fiscal incentives. Um, the U.S., United States of America's what they call them, foreign trade zone program. They don't offer corporate income tax as a benefit. What they give is the duty free exemption in terms of equipment and raw materials, etc., coming into the zone as long as it remains in the zone. Um, they give them no basically a duty waiver. There's no duties on those items, but they don't offer corporate income tax. But many zones around the world, within their regimes, that is, they offer a reduced rate as compared to what's applied in the domestic territory, what's applied in the rest of the country. So, the rest of the country might be paying, say, 25% corporate income tax, and then the zone is paying, say, 10. So it's a way to incentivize investments in the country, right? And of course, there are among other things. So this has become important because the OECD has been leading the charge around this matter. OECD and the G20 um, around this matter of looking to base erosion and profit shifting. So basically, people shifting operations from a high tax regime to a lower tax regime, and that can be done in a variety of ways, whether it be actually physically lifting up the plant and relocating it to a cheaper jurisdiction, or there are ways in terms of shifting profits and losses and that's type of thing in terms of transfer pricing, um, that those mechanisms are utilized by companies that operate globally. And that's cost, according to the OECD, a lot of money. A lot of the host countries see that as basically tax leakage, away from them. So this is going to become a very important topic in 2023 because the this thing is the that is the global uh, minimum corporate income tax is set to start taking effect um, this year, right? We've seen late in 2022, and we're in December, in fact, where the EU, in a sense, has cleared the way for them to institute that. So it's becoming critical for countries now to examine exactly what they're going to do, but also importantly for the multinational corporations to say, are you in scope? And it's not as simple as it seems. So first and foremost, one of the ways to check if you're in scope is, are you operating within a that's a multinational in a preferential regime? If you're not, then it's okay. Um, Two, and importantly, do your profits amount to cumulatively around the world when you add up everything, 750 million euros? If not, you are not in scope. Um, and there's some other as well as, are you from one of the exempt industries like shipping, for example, and mining? Those are exempt industries. So if you are shipping company, shipping line, and you're over 750 million euro, you're okay. Even if you are in a preferential regime. you're good, right? Because you're exempt. Uh, I'm personally, I can tell you, still unpacking this because there's some great nuance in how this thing is calculated and what falls in scope from what doesn't. A lot of people have said, okay, let's redesign our regime and create different types of taxes, which then in effect will lower it. But the OECD has also looked at that and said, we're gonna be factoring in those. Um, in addition, you may have a situation where the subsidiary company is operating at a loss. So that subsidiary may not necessarily need to pay anything because, well, technically there's nothing to pay, right? Also, to explain how one of the a critical mechanism, and I forget the name of what they call it exactly, but there's a critical mechanism within this global minimum corporate income tax, where it's the top up. So if you're below the threshold of 15%, so you're not forced, that is, the countries are not forced to change their laws to reflect. So if you are charging, say, 10%, you're not forced or compelled to change it to 15. What happens is the host country has the right to top up. So you have already charged your 10, and the host country says, well, I'll just top up and collect the remaining 5, right? So you're not compelled. Um, but a lot of countries are looking at it and saying, rather than give up that 5 or that extra tax revenue, I'll collect it myself. But you may not necessarily need to do that, because if the companies that you attract, even if they're multinationals, are not in scope, that is, they don't have 750 million euros globally, you may not necessarily need to change your law, and there is no top up. So it's important to understand that top up mechanism. So the question is, if you're a multinational, are you in scope, and what to do next? Now, the as I said, 2023, it's set to take effect. It's not fully in effect yet, but countries around the world are starting to move. And importantly, the countries from which, as the UNCTAD investment report pointed out, the countries that have the strongest FDI, they send out FDI. In Europe, United States, Canada, the main, I guess you'd say G7 countries, um, if they put in this regime without any other countries doing anything, we in effect have a global regime, because that's where the most of the FDI from around the world comes from anyway. So with the European Union moving, um, it's a significant stride towards implementing and bringing certain companies in scope, because 750, and it's gonna, I think, impact a lot of the larger tech companies, for example, and bring them under that radar, where countries are going to start to look at, the home country topping up, or even the host country looking to change their laws, because they're looking at, basically, since you're going to pay that tax revenue anyway, you might as well pay it to me, right? So if you like this episode, please like, share, subscribe. You want to see me cover a particular topic, just leave me a comment down below and I'll get right back.